So, comedian the other day, Chris, he said we should put Trump in charge of Navy pharmaceuticals.
Yeah.
Was he called like the Ozempic? He calls it the fat shot. It's like you need these descriptive adjectives or a better way to define the drug.
It's better because like they have the weirdest names for these pharmaceuticals,
I
right?
know.
Like
Yeah,
Mounjaro,
Ozempic, yeah.
and Zempic. Like these do not make you feel good.
No.
Like what does Ozempic sound like? It sounds like something like horrible, like a balloon you're going to put in your stomach or something. I can't explain it.
Well, Jose and I were talking about it before we started the podcast today. He was saying how it feels like a reality show, and go figure, Trump's a reality TV star. It's like the Trump sideshow.
Welcome to the weekly edition of the Payne Points of Wealth podcast, the podcast that addresses all the pain points that come along with creating, growing, and sustaining your wealth. Hosted by the family wealth experts of Payne Capital Management, Bob, Ryan, and Chris Payne. Please send us any questions or comments you may have to questions@paynecm.com. And please enjoy this week's episode.
Guys, with the big, beautiful bill, trying to get past as we're recording this right now. We're looking at cuts to Medicare spending. We're supposed to get some tax breaks on tips, Social Security, because, you know, if Bob didn't spend enough money, let's not tax the Social Security so he can spend more money so the rest of us can pay for it later. But I think the big question here is you were talking about $3.7 trillion deficit over the next 10 years added to our already $36 trillion deficit. That's a lot of money, and I think the argument here is, well, can we grow our way out of that? Meaning we're just going to have this explosion in artificial intelligence, productivity, that we're going to pay this debt down, or is this debt just going to keep ticking away, growing faster and faster, and slow the economy drastically over the next couple of years? Bob, what's your take on it? Is this the biggest, most beautiful bill of all time, or are we headed for some sort of financial disaster in the future?
I actually find it kind of hilarious, right? But that's, we have this Congressional Budget Office whose projections are never, ever accurate, right? They're always completely wrong. Nobody calls them out on it. They come out with a new bill, and it's like, well, the CBO isn't going to, this going to happen? Well, it never goes the way they say it's going to happen. So, I don't know why anybody believes in anything that comes out of Washington. But the second thing I know, and this is, I apologize to you up front about this, Rod, is that since you have graduated Villanova every year of your life, you have paid higher taxes no matter who's in office, no matter what party is running the government. And, your state, your local, your federal have all gone up. Now, I'm excited because of the baby boomer. I'll get a tax break. It's difficult. And they're going to get taxed by Social Security. So, again, the baby boomers are get taken care of. And it looks like you're stuck. Hold the bag again there. So,
well, we know if we were talking bipartisan politics, it's raising Ryan's taxes. That's one thing I know. But here's the smallest violin in the world. I know what you're going to say, Chris. But I mean, the question is, do you think we can grow our way out of all this deficit? That's the big question.
I mean, I'd like to think so. But I mean, if you think about the beginning of this year when Trump first got into office, there was this big move to cut government spending. They were going to address the deficit. Now it seems like they're increasing the deficit, and you never hear anything about what are they going to do in the future to address it.
Do you think they flipped the script, Bob?
I think what Doge found out is that the deficit, the biggest problem, are social programs. And that's the third rail. What politician is going to cut Medicaid, Medicare, or Social Security?
Yeah.
Right. And that, what's that, 2/3? Yeah, 3/4? I mean, it's a lot.
Well, I mean, also, it's... The stat is, I saw this morning, was between entitlement spending and interest on the debt, that's 73% of the budget.
Yeah.
If you're already giving a benefit, you're not going to be able to take it away. I think it's impossible. So I think that's one of the reasons what we're seeing right now is no matter what, deficit spending or adding trillions to the deficit is just inevitable. And unless there's a fire under Congress's rear end, you're not going to see any changes because, again, the bond market's not punishing you, right? We're actually seeing rates come down, which keeps that financing on the deficit in check to some extent. You're not seeing any sort of wild inflation being priced in. Besides the dollar weakening, which could be for other reasons, arguably, there's no consequences for the government right now not to keep spending. And until that happens, I think that's what you're going to see.
That's the problem. We had these forever politicians, right? There's no term limits. they're loyal to their constituents. So, I think that's what Doge found out. Like, no matter what you want to cut, there's constituency that's attached to it, right? That's going to go and revolt. And, that one vote you might be, they're not going to give you that vote because they like the Turks that, working one day a week and traveling all over the world on for the government's nickel. So, I think that, just like the simple thing, like the defense or NASA, they're trying to cut NASA's, the budget. And, one of the proposals was not to fund these, little rocket clubs in these high schools around the country. That's what politicians said. Well, it's only $300, and it's like, we're really going to get the money for the rocket club. Like, well, how the kids go out and wash cars for crying out loud? They'll raise their own money, but it's just like, so it's you down to that kind of minutia where they won't cut anything because there's a voter attached at the end of it. And I think that's really a big issue.
Well, I mean, Doge is the perfect example of that, right? Doge failed. Let's be real, right? We had Elon Musk come in there, the greatest cost cutter of all time. This man single-handedly brought manufacturing back to the U.S., right? He proved you could manufacture cars in the USA. You can't manufacture anything in the USA because he's so good at cutting costs. He went to Capitol Hill and they ran him out on a rail. So I think that tells you everything. To your point, Bob, is like there's such a vested interest to get reelected, and you have a constituency that nothing else really matters. And you can talk about, it's like they've kind of flipped the script. It was all about cutting costs when this administration first came in, Chris. And now all they're talking about is how we're going to grow our way out of it. I mean, is it realistic? Can we even grow our way out of this insane deficit, $36 trillion and counting?
I mean, I don't think so. I mean, the country's been growing. We've had innovation. We've become more productive, but the deficit still continues to grow. It's kind of like you ever see somebody that drives around in like a Lamborghini, wears all the fancy clothes, makes $1 million a year, but then at the end of the year, they're still in credit card debt. Like, I feel like that's the U.S. in a nutshell. I mean, I don't see us getting out of it.
Are you talking about Bob?
I was talking to Dad before the podcast, and he said that he's willing to forgo his Social Security check just to help the deficit.
Elon Musk is all his time and effort, and then of course, the big breakup comes, which everybody and their brother knew was going to happen. You can't have the two biggest egos in the world exist in this space, and now they're threatening Musk to pull his subsidies. What? It's a guy, he works for free, tries to cut spending, right? He ends up getting his factories bombed, his car is blown up, his brand destroyed.
Yeah, not to mention he spent $200 million on the Trump campaign. So, man, like talk about, insult to injury. And now it's just like the back and forth on Twitter between Trump and Musk is getting out of hand. Look, I mean, the big, beautiful bill, maybe it's big and it's not beautiful, or maybe it's both, depending if you talk to Elon Musk, you talk to Donald Trump. But I think what we have to expect here is to expect the unexpected. Whatever the consensus opinion is, how the markets are going to react, whether it's the stock market, the bond market, right, the dollar, we don't really know. So when you're building your investment strategy, you have to prepare for anything. That's the Payne principle you want to apply today when you're building your portfolio for future wealth. Should the Federal Reserve cut interest rates? Do we have the data? Inflation is down. We have full employment. Or if we do cut, does that cause some sort of melt up? Where do you stand on that, Bob?
Well, first of all, I think it's really not how that we got to watch. You got to watch the jobs numbers. I mean, if the employment numbers stay strong as they have been, right? If the jobless claims continue to stay muted, I don't think you're going to see a cut from the Federal Reserve. But here's the thing that cracks me up. It's like, who appointed Powell to the chairmanship of the Federal Reserve? Trump. Yeah, now he wants to fire him. Do a better job of hiring people, man. I think the bond market's doing the job for Jerome Powell. I mean, we had the 10-year Treasury bond was yielding 4.7% at the beginning of the year, guys. It was under 4.20 today. Almost down to 4.10.
Yeah, but I think I can argue there that's the reason why they should be able to cut. It's saying because inflation's low. Here's my problem. First off, I think Jay Powell, or Jerome Powell, as we like to call him, Jay Powell, I think he is going to cut. And I think it's because Trump is putting so much pressure on him. In fact, he alluded to it in whatever meeting there was 2 weeks ago, that they're probably going to cut rates two times this year. Now, at face value, they should do it because, to your point, Bob, the market's done the work for you. We've seen yields come down. Look, we have low oil prices, which drives all sorts of inflation. And we have full employment. And like, you have 11,400 baby boomers retiring every day. We're going to continue to have a labor shortage in this country. I don't care what anybody says. The labor market's not going to fall off a cliff. But here's the moral hazard. Remember last time the Fed cut rates was back in September, and long-term rates actually went up because it was stimulative. And the other big problem I have with it, and we talk about this a lot, but there's $7 trillion sitting in money market funds right now. And remember our clients last year were getting 5% on their money market fund, Chris? And then all of a sudden the Fed cut interest rates, and now it's at 4%. If they cut again, it could be like 3.5%. And my fear is, and you can tell me what your clients are, how they react to this is you're going to have a lot of investors saying, I'm only getting 3.5%. The S&P 500 is going up. I want all my money in the stock market, and you could get a huge melt up here.
Well, I don't think my clients would say that at all because I browbeat them over the last year to get out of those money markets and get back in the market. But I don't really see a reason for them to cut now. I mean, I feel like back in September, they didn't really need to cut. I don't really see, you made the point that rates are already going down. Like, why do they need to cut rates? I mean, the market's doing great. GDP's up. Like, why is it necessary?
No, I really don't know whether he will or whether he won't. Again, that comes back to no one knows. But if you're sitting around waiting, it's kind of like, you look at the short end of the curve, which has been dropping. In other words, shorter term, intermediate term bonds is where the money's going, right? If it's coming out of the money market, they're buying 1 year, 2 year, 5 year bonds, corporate municipals, and they're really not putting money into the long term maturities, right? Where the real sweet yields are. So I think it's going to happen. It's like a flood, right? You're clinging to this tree as this flood of money's coming your way. And it's just going to be too hard to resist because once you realize that you've missed it, right? That you watch the stock market go up, watch the bond market go up, and you're being safe and sound in your 1 year, 6 month treasury, you're going to panic. And because I'll tell you what, guys, in my 50 years, I've never seen anything more motivating than your next door neighbor getting wealthy. I mean, jealousy is the greatest motivator. People will buy something, stupid like Bitcoin just because somebody next door made money in Bitcoin.
It's the total FOMO trade, and I think that's what we're building up to. I really think in retrospect, I think there's no way the Fed's not cutting interest rates. I think Jerome Powell has proved over and over again he does play the political game, right? Because he was citing back in September that he could cut rates because the unemployment market was weak. Now he's citing that he won't cut rates with the employment market looking like it could get a little bit weaker. He didn't, let's face it, he didn't raise rates until he got renominated. Everyone was wondering why when we had inflation over at 9%, he didn't raise rates right away. It's because he was waiting for getting the job back, basically. So, I think if he does cut rates, and I think it's going to happen, that's when he's not going to look smart retrospectively. Because to your point, Bob, that's like you're basically opening the floodgates in terms of trillions of dollars coming into the markets, the bond market and the stock market, to your point, because you keep watching your money market fund go down in interest rate, you're going to want to start to lock into bonds. Well, bottom line is that's what could inadvertently cause a melt up. And I think we are going to have a melt up at some point.
I got to say, going back to what you were saying about Jay Powell lowering rates because he wants to secure his job, I find that inherently disturbing. Does he need the money? I mean, does he need a financial plan?
I still think there's no reason he shouldn't cut based on what stable prices and full employment are his two metrics. He's met both those metrics. So he's really contradicting himself if he actually doesn't cut rates here. That's the problem. He's actually painted himself into a corner.
Well, I think the bigger issue, and I think this is pretty exciting if you think about it. We've had an economy that's been incredibly resilient, right? No matter what we've thrown at it, right? The economy continues to grow. GDP numbers stay consistent. Earnings estimates are going up, in spite of all these other headwinds. So what happens if we do get rates to drop and the mortgage rates come down, even 100 basis points, 1%, a 1% or 2% drop in mortgage rates? That's going to spark a huge investment in the housing market, which has been missing, right? this resilient economy we've had hasn't had the housing market, which is, historically been the backbone of the U.S. economy.
Well, two comments on that. The resilience of the economy is almost as resilient as your hair, Bob. So I think that's number one. But number two, I think we can't bet that that's going to happen. If the Fed cuts rates like they did back in the fall, longer term rates went up because it is stimulus to the economy, right? You have a lot of businesses, they borrow short term. We know a lot of these private equity firms, when they do deals, they borrow short term. So that unlocks a lot of capital that's probably been sitting on the sidelines, gets invested, which actually picks up economic growth. And if we have higher economic growth, we have more inflation, which means we have higher interest rates. So I think this is kind of a misconception that if the Fed cuts rates, all of a sudden, longer-term mortgage rates go down. I think they could actually go up, and nobody's talking about that.
Hey, Dad, Ryan said that if rates do go down and the mortgages do go down, he said he's going to move out of your basement.
No. I'm never moving out of Bob's. If I could stay at Bob's house, 24/7, I would.
So I think it's interesting, guys, that what you think Jerome Powell should do, what you think he's going to do, but at the end of the day, it comes down to the Payne principle of wealth, that time passes and markets operate, right? So we've been having this discussion. The market's been, doing its thing, and guess what? It doesn't care what you think. It doesn't care how you feel. And that's the problem with any issue, that's the front burner on the nightly news, right? It's already priced into the market. And the only thing I could say after this segment is you're not wrong. You have been so wrong.
Hey, hope you're enjoying the most recent episode of the Payne Points of Wealth podcast. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially literally at any stage of your journey. But if you want a more hands-on approach and you saved over $1 million for your retirement, Bob, Chris, Courtney, and I will run for you our total financial master plan, and we'll do that with no obligation or cost. It's a full holistic review. We literally look at everything. We'll go as far as building you your own personalized financial portal. We'll give you a bird's eye view of your entire financial life and hone in on every financial issue you need to address today, whether it's an income plan for retirement. How do you take Social Security? How do you draw from your portfolio, factor in inflation, and don't run out of money? We'll look at diversification. Markets have been wild over the course of the last couple of months. Has your portfolio been up and down? Or have you been sitting in cash, CDs, money market funds, paralysis by analysis? We'll put together a full investment game plan. We'll show you how to grow your wealth, but most importantly, protect it over the rest of your life. And we'll look at fees and taxes. Wall Street loves to sell you high cost, tax inefficient products, whether it's an annuity, mutual fund, insurance product, structured product. We'll do a deep dive of every investment you own. We'll show you how to reduce the cost and optimize your portfolio for taxes. It's not what you make, it's what you take. You'll get a full tax playbook, and we'll do this full review at no cost. We'll literally go through everything for you, do all the work up front. Simply go to www.paynecm.com/financial plan or click the link below to see if you qualify for a free financial review. So the next topic I want to talk about is everyone's in a tizzy here in New York. You're hearing about people wanting to move to Florida because we might apparently elect some communist named Zoran Mamdani. Let's face it, taxes in New York are high. We already have lots of problems with housing. And I think where he's actually hit a nerve with people is we actually do have a housing shortage in New York. But one of his suggestions here is to spend over $100 billion and just create more affordable housing. And of course, people are just going berserk. So, Bob, what's your take on this? I know you love communists.
First of all, let's clear the air here, Ryan. I love free market capitalism. I love the good old U.S. today. And I love Margaret Thatcher because she opined on this issue 30, 40 years ago, which she said she loves socialism. And it's great until you run out of other people's money. And that's really what it comes down to. It's like, if you want to eliminate all billionaires, right? We shouldn't have billionaires. You shouldn't have people that had tremendous success. Where are you going to get the money to fund these projects, right? These programs. I mean, I would love to hear your buddy John Katzabati's comments on, putting in government-run supermarkets. And what's that going to do to his supermarket business?
Well, I can assure you, if you talk to anyone in Venezuela or the old Soviet Union, how well they're run and how they're always well stocked. Think about it, these are the same people that run the subway system here in New York, which is fantastic, by the way. If you want a system that literally is, not clean, barely runs on time, People are creating bonfires in the trash cans. So yeah, it's that kind of bureaucracy, which we know doesn't function very well, takes over the New York City. I think that it could be a very, very scary place to be. And that's why you're seeing so many people up in arms right now about, what can happen in the city.
Well, the one thing I've seen with communism, you bring up, Cuba and Venezuela, is that all the entrepreneurs and wealthy people, the intelligent people, all move away, and this is what you're left with. And you know what? New York is really not in great shape to begin with. With a $5.5 trillion a year deficit.
I think, I'm actually back at this guy because it's really helping my real estate values down in Florida. and we talked about earlier, we talked about, voting with your feet. If you're going to end up paying 80% of your income to taxes, there's just no way in the world anybody's going to sit still for anything like that.
No, I agree with you 100%. And I think also, but it does speak to what is on people's minds right now. And the reason this guy's even getting any sort of relevancy, and that's because we have a housing shortage, right? If you look at it across the country, we've underbuilt now for over a decade, and there's more people looking for a home than there's homes available. In New York, it's probably more exacerbated than other places. But, I think what's interesting right now is even with this housing shortage, we're not seeing a lot of real estate moving right now. And I think a lot of that has to do with the fact that you have buyers and sellers at a standstill, Bob.
Yeah, and I think that's the issue. Even we think the average kid coming out of school today, they're saddled with so much student debt. I didn't even know they qualify for a mortgage. First of all, they're already leveraged coming out of college, and it's frustrating right now. The job market's really not that strong for entry-level jobs, believe it or not.
No, and I wonder if some of that's just indicative of the fact that we had tariff turmoil. There's a lot of uncertainty. Businesses don't want to hire short-term. And I would almost argue it's probably a speed bump. Like at some point, the floodgates probably open again. But I think there is, because there's been so much uncertainty this year, especially with tariff turmoil, you have companies holding off on a lot of decisions. And I think that's one of the big reasons why you're seeing a lot of these kids right out of college. In fact, we have interns here that I thought were going to get a job. They're still hanging out as interns. So I'm thinking right now, maybe they'll be our interns for a lot longer.
Ryan has this new communist strategy where we're hiring everybody that doesn't have a job this summer.
Well, what I wonder, Chris, is I think the fear here is like New York's still a very vibrant city. People are here, but you and I were out in San Francisco not that long ago. And I mean, literally there was nobody there. I mean, it was abysmal. There were lots of people on the street harassing us. People were stealing stuff out of the stores in broad daylight. Like, is that the big concern here? Is we have the same type of situation here in New York City?
Yeah, definitely. I mean, San Francisco was a big, thriving city. And it's funny, even when we were there, I remember you and I went and got lunch. I had like a grilled cheese sandwich. You had a salad. It cost us $60. So yeah, I mean, I definitely see something like that for New York. And it's one of those things like people don't change unless they're forced to. So, you start seeing people flee the city, you lose tax revenue. Yeah, I could definitely see something like that.
Yeah, but meanwhile, we're still at like peak prices. And I think one of the problems is you do have buyers and sellers at a standstill right now because people have raised their prices a lot. We had 2% interest rates during the pandemic. So, whatever you could sell a house for, obviously, if you're buying that house, your carrying costs were a lot less than today. It's 7% interest rates. But I don't think the prices have adjusted to the fact that if a buyer buys your property, they're now going to be paying a much higher interest rate. And I think what you're going to have to see is some sort of price adjustment at some point here. I think you're going to have to readjust prices downward to compensate for the fact that now a mortgage payment's at 7%, not 2%. It's a big deal.
I think that when you look at socialism, communism, it's really kind of more about feeling than thinking. But the problem is you have to pay for it. And right now, if you're a resident of New York, you're in the highest tax bracket, you're paying close to 15% when it comes to state and local. And clearly, I don't know what the proposals are from this candidate, but it's going to be higher. And at some point, it's smarter to move to a state where you don't pay it. I mean, you make $1 million, you take 15%. That's a lot of money you could spend on you and your family versus getting into a government for future benefits. So I think the paid principle of wealth that applies here, guys, is anything paid in taxes is a permanent loss. So it's not just managing your portfolio, it's managing, what you pay in taxes. If you live in the state of New York, try to buy state of New York municipal bonds. You're completely tax-free, triple tax exempt. So you got to manage the tax part of it. So as one of the principles of Payne Capital Management always says, it's not what you make, it's what you take.
Hey, hope you enjoyed episode 209 of the Payne Points of Wealth. If you like our podcast, you love our podcast, please give us that 5-star rating and subscribe on iTunes, on Spotify. If this is on YouTube right now, you can like this episode, subscribe to our channel, click that notification bell, be updated every week of all our new content. That's it for this week. As always, stay loose and keep an open mind.
Thanks for listening to the Payne Points of Wealth. Hopefully you found the ideas discussed in this episode valuable and useful for your own financial journey. You can find out more about Bob, Ryan, and Chris's firm, Payne Capital Management, at bebullish.com or through the contact information found in the description of this episode in your podcast player or app. Join us next week for another episode of The Payne Points of Wealth, brought to you by Payne Capital Management. Information provided on today's show is provided for informational purposes only and does not constitute investment, tax, or legal advice. Investment is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed.